The market is closed, and Opendoor Technologies Inc. Open finished the last trading session at $9.07, representing a brutal 13.78% drop on Friday. This kind of volatility is becoming the defining characteristic of this stock, and it's a stark reminder that while the recent surge has captured headlines, the underlying fragility remains. Many investors, particularly those new to self-investing, see a chart like Opendoor's over the past month and think they found the next rocket ship. They see the explosive rally from its 52-week lows and believe the turnaround is complete. They hear about the new leadership and think the company is on a clear path to profitability, ready to dominate the real estate market. The expectation is that this is the beginning of a sustained upward trajectory, a classic growth stock story unfolding in real time. But the reality, as Friday's action so painfully demonstrates, is far more complex and fraught with risk. The sharp, rapid decline wasn't just profit-taking, it was a systemic rejection of a price point that many institutions believe is simply unsustainable given the current macroeconomic environment and the company's business model. It's the market's way of saying, wait a minute, this is moving too fast for the fundamentals. This creates a fascinating tension for anyone looking at this stock, from an individual brokerage account holder to a large-scale Fidelity investments manager. Is this just a necessary pullback on the path to greatness, or is it the start of a more significant correction? The daily trading volume for Opendoor has been nothing short of astronomical, with over 472 million shares changing hands on Friday alone. This isn't just a handful of people trading. This is a massive, coordinated movement of capital. A significant portion of this volume can be attributed to the meme stock phenomenon, where retail investors, often organized on social media platforms, buy en masse, creating a short squeeze. We've seen this narrative before with stocks like AMC and GameStop, and the pattern is eerily familiar. On one hand, this surge in retail enthusiasm has been the primary engine driving the stock's recent ascent. On the other hand, it makes the stock highly susceptible to dramatic and sudden reversals, as was the case on Friday. Institutional activity tells a different story. While some institutions might be cautiously dipping their toes in, many others appear to be using the retail-fueled rally as a liquidity event to exit or reduce their positions. This is a classic smart money versus dumb money debate playing out in real time. The reality is that the new CEO and returning founders, while a positive catalyst, haven't had enough time to act any significant changes that would fundamentally alter the company's financial trajectory. The excitement is based on a future hope, not a present reality. When you are looking for investment help, or even considering an intelligent portfolio, you must look past the hype and into the details. Opendoor's business model is centered on a concept known as iBuying, or instant buying. The company uses proprietary algorithms to make cash offers on homes, buys them, makes light repairs, and then relists them for sale. The goal is to provide a fast, convenient, and predictable way for people to sell their homes, bypassing the traditional real estate agent model. This model, however, is highly sensitive to the housing market. In a bull market where home prices are consistently rising, Opendoor can profit from the appreciation of its inventory. But in a volatile or declining market, the company can get stuck with homes that are losing value, leading to significant losses. The current macroeconomic climate, marked by stubbornly high interest rates and a cooling housing market, presents a major headwind. Mortgage rates are at levels not seen in years, significantly impacting the affordability of homes and slowing down transactions. While Opendoor's past performance shows a rapid scaling of its business, it has consistently reported significant losses, struggling to find a path to sustainable profitability. The company is, in many ways, an experiment in whether a tech-first approach can truly revolutionize an asset-heavy, cyclical industry. SoFi Invest and other online investing platforms make it easy to buy into a narrative, but a strong narrative doesn't always make for a strong investment. Looking ahead, the future of Opendoor stock is a battle between technical momentum and fundamental reality. The technical analysts and momentum traders, the kind who utilize platforms like interactive brokers to execute rapid trades, will be watching for signs of support around the $8 to $9 range. If the stock can consolidate here and find a new base, it might be able to mount another attempt at its recent highs. But if it breaks below this key level, the next stop could be significantly lower, potentially erasing all the recent gains. The fundamentalists, on the other hand, will be waiting for concrete evidence of a turnaround. This includes shrinking losses, improving unit economics on each home transaction, and a clear path to generating positive free cash flow. The company's next earnings report will be a critical moment. Will the new management team announce a pivot that shows a greater focus on cost control and efficiency, or will they continue to prioritize growth at all costs? The market needs to see that Opendoor isn't just a volume-based operation, but one with a sustainable profit margin on each home it buys and sells. In an online investment landscape saturated with options, a Fidelity brokerage account or a Robinhood stock trading account offers easy access, but it does not provide the discipline required to analyze these complex factors. The risk profile for Opendoor is exceptionally high. On one side, you have the potential for a massive short squeeze, with a significant percentage of the company's float currently shorted. Any positive news, even a hint of an improving housing market or a strong earnings report, could trigger a cascade of short covering, sending the stock soaring. This is the lottery ticket aspect that some investors are chasing. On the other hand, the company faces an unforgiving macroeconomic backdrop. The Federal Reserve's stance on inflation and interest rates will be a major factor. If rates continue to climb, it will put even more pressure on the housing market and Opendoor's core business model. Additionally, competition from traditional real estate brokerages and smaller iBuyers remains fierce. Opendoor has to prove that its technology and scale provide a defensible, long-term competitive advantage. This isn't a Tesla stock which has a massive and loyal consumer base, nor is it an Apple stock with its fortress-like ecosystem. This is a much more speculative play, and anyone considering adding it to their portfolio should do so with extreme caution. This kind of high-risk, high-reward proposition is exactly what makes the market so compelling for those who embrace the volatility. However, it's also why many people opt for a Schwab Intelligent Portfolios or other robo-advisors that remove the emotional component of trading. The question for investors now is whether they believe the narrative or the numbers. The narrative says a new CEO and founder-led revival will usher in a new era of profitability. The numbers, as they stand today, show a company burning cash in a difficult market. The recent price action is a perfect illustration of this struggle. A spectacular rally, followed by a punishing correction, suggests the market is still very much in a discovery phase, trying to figure out what Opendoor is truly worth. Comment below and let me know how you think Opendoor's new leadership will handle the current housing market headwinds. Do you think they have what it takes to guide the company to consistent profitability, or is this just a classic meme stock pump and dump? Your investment decision, whether it's through a Fidelity mutual funds or an individual brokerage, must be a product of your own diligent research. In the end, the true value will be determined not by the hype, but by the company's ability to navigate the brutal realities of its market. The expectation of a quick and easy turnaround has just met the reality of a complex and challenging business environment, and Friday's sharp decline was the market's blunt reaction.